So that's the return of, wow, 17 times. Hi guys, it's Eric from Hong Kong, based in Germany. I have been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspectives about investing in Chinese stocks and also in personal finance. Today I want to talk about how to use $1 to buy $10 worth of assets. It's very simple, no tricks, no sleepless night about buying Bitcoins. Just simply invest in a stock based on solid assets and cash. So a few days ago, I bought a stock called G Resources, which is listed in the Hong Kong Stock Exchange with the ticker number of 1051. It has a market capitalization of around 1.3 billion Hong Kong dollars, which roughly equals to 165 million US dollars. And you guess how much is the net asset value, NAV? It's 1.57 billion US dollars. Yes, almost 10 times more than the market capitalization. As a result, the price to book ratio, PB ratio, is 0.106, which is extremely low. You can literally buy $10 worth of assets with around $1. So even more interesting is that they have 965 million US dollars of cash. Well, you may say 965 million US dollars of cash doesn't mean anything if they have a lot of liabilities, right? So the liabilities, current and non-current, add together is around 60 million US dollars. So that means after deducting liability, they have a net cash of 905 million US dollars. Let alone there are around 605 million US dollars worth of other assets. And the market capitalization again is 165 million US dollars. So what does G Resources do then? They literally owned a gold mine, which they sold back in 2015 for 760 million US dollars. So that's why they have so much cash. And the main business now is financial investment, which including investing in stocks, bonds, and other securities. Also, they have so-called financial services, which is basically the stock brokerage businesses in Hong Kong. Of course, they also have some real estate, which they just lease out to get some rental income. 2020, they earned 73 million US dollars, which is up 68% comparing with 2019. So the business is doing well, and such a low PB ratio. One of the following scenarios is very likely to happen. First of all, it will be privatized by the main shareholder. Secondly, it might be acquired by another company or persons. Thirdly, they might use the money to acquire other assets or do some merger and acquisition activities. Fourthly, they might just liquidate the company so that the money and assets could be released back to all the shareholders. I think the most likely scenario would be number one, privatization. I will have a separate video to talk about privatization of companies listing on Hong Kong Stock Exchange, because I know a number of them have very high likeliness to be privatized, and we can make a lot of money out of that. In any one of these cases, the stock prices shoot up a lot. Scenario one is the most likely, because this would benefit the main shareholder the most, while the rest of the shareholders would still okay with it because the profit would still pretty good. So in scenario one, I would have a hypothetical situation. So given that now the market capitalization is roughly 165 million US dollars, and around 28% is owned by the main shareholder. So if they want to buy the rest of the company, they need to have at least 118.5 million US dollars. But of course now the PB ratio is 0.1. No one's going to sell it, right? So assume that they raise the price to up to PB equals to 0.3. So the price to book ratio up to 0.3 means that the main shareholder who owns 28% would need to spend around $355 million to buy the rest of the company. This can be easily done. They can just borrow money from a bank, $355 million, and then they get hold of the control of the whole company, which worth $1.57 billion. And then out of this $1.57 billion, 965 million are actually cash. They can use the cash to pay back the loan of $355 million, plus some interest and administrative fees. But then they would be left with around 610 million cash plus 605 million of other assets. That's a pretty good deal, right? Given that they bought the company at around $68.6 million to own around 28% of the shares. So that's the return of, wow, 17 times. And for us, it also means that for every $1 we invest, we will get $3 back. That's a 200% of profits. So is it too good to be true? Is it a fraud? But if you look at that, they actually have a legitimate reason to have so much cash because they sold gold mine for $760 million. Secondly, they have relatively simple assets, cash, financial assets, which is like stock and bonds, and also real estate. So from the audit point of view, it is not something that is easily fabricated. And the third point is that they changed hands in 2018. So I'm pretty sure the new owner did their due diligence before they actually bought the company. Second question is that since we base a lot of the NAV, so would the NAV fluctuate a lot? Well, first of all, the NAV of $1.57 billion, out of that, $965 million are cash. So this is clear. If you look at financial assets, not all of them are being revalued every single year. So around $382 million of financial assets would be evaluated every single year. So this is the part that would fluctuate, and it accounts for around 24% of the NAV. And also, of course, they have real estate, but real estate is not really a problem because they might revaluate the real estate every year because of the house price, but the building is still there. And usually, if they lease it out, the rent is not going to change immediately. So this is not a big concern. And also, if you look at the financial services, basically the stock brokerage companies, they count for around 15% of the NAV, and it's not going to disappear overnight, right? So I don't think this would be a concern. The only concern is about the financial assets, which count for 24% of the NAV, which would be evaluated every single year. But I don't think this is a huge concern for us because we have a lot of buffer given the NAV is 10 times higher than the market capitalization. So how much shall we expect G resources to go up? From the scenario I've mentioned earlier, it could be up to 200%. I would be more conservative to set the target at 150%. On the other hand, we can also take reference of the former mother company of G Resources, China Strategic Holdings. So this company is also listed on Hong Kong Stock Exchange with a ticker number of 235. So by the end of 2019, the stock price of this company was 6 Hong Kong cents. The PB was around 0.17. By the end of 2020, the stock price went as far as 26.5 Hong Kong cents with a PB of 1.21. It went up around 7.6 times. The profit was 660%. That's crazy, isn't it? A word of caution, of course, this is a penny stock. So that means it's going to fluctuate a lot. Moody's Analytics actually rated 7 out of 10 in terms of risks. So you need to be cautious and not putting all your money into this company. A number of retail investors in Hong Kong were still not very happy about this company because it went down a lot in 2009 and 2010. So we need to be cautious. Also, it does not pay dividend. From my point of view, it's actually a good sign. If they are not paying dividend, that means that either they are preparing to acquire some other companies, other assets, or they are planning to privatize. That's why they want to keep as much cash as possible. So personally, I think this is a risk worth taking. Of course, it would fluctuate a lot and you need to mentally prepare for it. And we need to wait at least 1 or 2 years for it to bear fruit. But I think it's still better than Bitcoin. What do you think about it? Please give me a comment below. If you liked the video, remember to like it, share it, and subscribe to our channel.